Welcome to Lesson 3 of Module 2 on risk management. Today, we will focus on stop-loss and take-profit strategies as part of the ForexDelight Trading Mastery course. First, what is a stop-loss? Think of it as your emergency exit. It is an order that automatically closes your trade when a predetermined price is reached. A stop-loss limits your potential loss to your 2% risk rule, removes emotional decision-making, and protects your capital while you sleep. Most importantly, it prevents a single bad trade from destroying your entire account. Remember this cardinal rule: never trade without a stop-loss. This is non-negotiable, period. Without a stop-loss, a 500 pip overnight move could wipe out a $1,000 account. With a stop-loss, that same move limits your loss to $20 or 2%, ensuring you can still trade tomorrow. So where should you place your stop-loss? Placement should be strategic and based on technical analysis. For a buy trade, place your stop 5 to 10 pips below key support. For a sell trade, place it 5 to 10 pips above key resistance. You can also place it beyond the recent swing or use an ATR-based calculation. Always avoid exact round numbers, as they are often targeted by stop hunters. Next, let's look at fatal stop-loss errors. Never move your stop-loss further away to increase your maximum loss, except defeat. Also, setting your stop too tight means normal market volatility could prematurely close your trade. Additional mistakes include setting a stop too wide, violating the 2% rule, trading without any stop loss, or relying on a mental stop loss. Never remove a stop loss, because assuming the price will return is a path to failure. Now let's define take profit. This is your profit target. It is an order that automatically closes your trade when your intended target price is reached. A take-profit order locks in your gains before a potential reversal, removes the emotion of greed, executes while you're away, and forces strict trading discipline. Take-profit levels are strategic targets based on price action and structure. A good starting point is placing them at the next major resistance or support level where price may reverse. Alternatively, target a minimum 2x or 3x risk/reward ratio. Other strategic placement points include Fibonacci retracement levels like 38.2%, 50%, and 61.8%, previous swing high or low points, and major round numbers like 1.1000 or 1.2000. We recommend aiming for a minimum 1 to 2 risk/reward ratio. This means risking $1 to make $2 or better. With a 1-to-1 ratio, you risk 50 pips to gain 50. Needing a 50% win rate just to break even. A 1-to-2 ratio means risking 50 pips to gain 100, requiring only a 33% win rate to profit. A 1-to-3 ratio needs only a 25% win rate. A trailing stop loss is a powerful tool to lock in profits as your trade moves favorably. It automatically moves your stop loss closer to the current market price. For example, if your entry is 1.1000 with a 50 pip stop and the price moves 100 pips in your favor to 1.1100, you can move your stop to 1.1050, securing a minimum 50 pip profit even if the price reverses. An effective strategy is using multiple take profit levels, often called scaling out. This allows you to take partial profits as the trade progresses. If you trade 0.3 lots, you can split it into 3 0.1 lot positions. Close 0.1 lot at TP1 for guaranteed profit, another 0.1 at TP2 for banking more, and the final 0.1 at TP3 for maximum gain. Remember to move your stop to break even after TP1 hits. Let's put it all together with a complete trade example. With a $2,000 account and a max risk of 2% or $40, an entry at 1.1000, a stop loss at 1.0950, and a take profit at 1.1100 gives you a 1-to-2 risk/reward ratio. This requires a position size of 0.08 lots, resulting in either an $80 win or an exact $40 loss. The key takeaways are to never trade without a stop loss, place it strategically with a buffer, and never move it to increase your loss. Set your take profit at technical levels or a minimum 1-to-2 R/R ratio. Use trailing stops to lock in profits and scale out at multiple levels. Always calculate your trade parameters, including position size, before entering the market. Join us for Lesson 4 on risk/reward ratios and managing trades.